Welcome back to Personal Finance Simplified. I'm your host, Ishika Chandra, and today is Wednesday, July 22nd. Today's topic is credit cards. In order to learn about credit cards, we're going to need to know what a credit score is first. A credit score is a three-digit number ranging from 300 to 850 that helps lenders determine how likely you are to repay borrowed money. The better your credit score, the more likely you are to qualify for loans, lower interest rates, higher credit limits, and sometimes even lower insurance premiums or easier apartment approvals. The credit score is given to you based on 5 factors: payment history, credit usage, length of credit history, types of accounts, and recent activity. So I'm going to go over each of these 5 factors separately and explain them more in depth. So first up is payment history. This is the most important factor that goes into your credit score. This measures whether you've paid your bills on time. So when you take out a loan, for example, you could take out a loan for 5 years, 10 years, 20 years, and each month you have to pay a set amount of money to the bank, which includes the money to pay back the bank as well as interest. So if you pay the bills on time each month, then your credit history will go up. However, if you make a payment a couple days late, you may have to pay a late fee, but many lenders don't report this to credit bureaus until it's 30 days past due. So a credit bureau, just in case you don't know, is what creates your credit score. So if you make your payment a couple days late, your credit score most likely won't drop. However, if your payment is 30 or more days late, your credit score will drop because the lender will report this to the credit bureau. If your payment is more than 6 billing cycles, which is around 6 months late, your account will close and your credit score drops significantly. The lender that you have to pay this payment to will tell a debt collector that you haven't paid them, and the debt collector will contact you to try to get your money. And so a debt collector might come to your front office, call you, try to contact your friends and family in order to get your money, but they're not allowed to harass or try to do anything violent towards you. However, it's very important to make sure that it doesn't get this far. The second factor that goes into your credit score is credit usage. So this is basically how many accounts have money in them and how much money you owe to people, as well as the percentage of total revolving credit limit that you are using. So that's a little bit complicated, so let me give you an example. So you're going to get a credit limit based on your credit score from the credit cards. And so if your total credit limit across all credit cards is $10,000 and the amount you have used on your credit card for 1 month is $500, your credit utilization is 500 divided by 10,000 times 100, which is 5%. The credit utilization is very important because people who lend money to you want to see that you can borrow money without relying on your credit limit. So usually the lower your credit utilization is, the more it will help your credit score. So most people try to keep their credit utilization below 30%. However, if your utilization is above 50%, it will significantly lower your credit score. So for example, if your total credit limit is $10,000 and you spend $8,000 in 1 month, then your credit score will drop because they don't want you to be spending the maximum that you can. The maximum is just there for letting you know this is how much you can get, but they don't want you to be spending that much. The third factor that goes into your credit score is your length of credit history. This is the average age of all your credit accounts. A credit account, by the way, could include credit cards, mortgages, auto loans, student loans, and utility bills. The length of the credit history also includes the age of your oldest and newest account. So the longer ago your oldest account is, the higher your credit score will be, because creditors can see more about your history. And the more recently you open your newest account, it can lower your credit score because this reduces the average account age, which is a big factor of the length of credit history. Another factor that goes into your credit score is the types of accounts. So this is whether you're managing both an installment account and a revolving account. An installment account, by the way, is a credit where the borrower receives money in the beginning and pays it back in scheduled payments over some time. So that's a little bit complicated. So let me give you some examples of an installment account. So this can include a car loan, a personal loan, a mortgage, or even a student loan, because this is money that you have to pay back in scheduled increments over time. So you're going to be paying the bank back every single month. A revolving account is a account where you borrow money up to a set limit, repay it to the bank, and then borrow again. So this could include credit cards because you borrow every single month and repay it to the bank every single month. If you can manage both your revolving accounts and installment accounts properly, which basically just means that you don't do any late payments, your credit score will increase. The next factor that goes into your credit score is the recent activity. So this is whether you've recently applied for any accounts or opened any new accounts. So for example, if you've gotten a new credit card recently or taken out a loan. So this is because every time you apply for a new credit account, the lender may perform a hard inquiry, which a hard inquiry, by the way, is when the lender checks your credit report to make a decision. And too many hard inquiries in a short period can lower your credit score because it signals that you're taking on a lot of debt. But 1 or 2 applications isn't that big of a deal. And the reason why this is a red flag to lenders is because when you are in trouble, for example, you owe somebody like $20,000, then you would go to multiple banks to go ask them for $10,000 or $5,000 in order to pay the person off. And if you take out 3 loans in order to pay somebody else off, then it signals to other people that you are in trouble and people will be hesitant to lend you more money. So these are all of the factors that lead to the calculation of the credit score. However, you might be curious about what these scores mean and what your points mean exactly. So again, a credit score ranges from 300 to 850. And there are 2 companies that calculate your credit score, FICO and Vantage Score, and they both calculate your credit score differently and determine if you're good, bad, or fair to lend to in different ways. But typically, a score from 300 to 579 is a poor score. A score from 580 to 669 is a fair score. A score from 670 to 739 is a good score. A score from 740 to 799 is a very good score, and a score from 800 to 850 is an excellent score. So your credit score determines your interest rates and insurance rates, so it's important to keep it as high as possible. Most people would try to keep it, so right now you know what a credit score is and what a good credit score looks like, but you might be wondering, how do you get a good credit score? So I've got a few tips for you in order to get a good credit score. So the first tip I have for you is to pay your bills on time always. This is the biggest tip because even one late payment can hurt your credit score significantly, and this stays on your credit report for years. And the credit report is what people look at when they're deciding whether they want to give you a loan or not. So if you have a late payment on your credit report for the next few years when you're applying for a new credit card or applying for a new loan, they're all going to see that you paid your bill late. So it's really important to pay your bills on time. So a few tips for paying your bills on time include turning your auto pay on for at least the minimum payment for bills. Set your calendar reminders a few days before your due date. Try to pay the balance in full every month to avoid interest, because interest rates for late payments can be really high, especially for credit cards. So you might have to pay like 30% interest rate if you pay your bill late. The second tip I have for you is to keep your credit utilization low. So don't spend all of the money that you can on credit cards. So aim for spending under 30% of the maximum and under 10% if you really want to get a super good credit score. The third tip I have for you is to not open too many credit cards. So for example, stores offer credit cards. So some stores that I know that offer credit cards are Amazon, Target, Walmart. So if you go shopping on Amazon, for example, if you open a credit card with Amazon, they'll give you $250, which might sound like a really great deal. So, which by the way, this is not sponsored by Amazon, so I can't tell you whether it's a good deal or not. But for this tip, I'm telling you to not open too many credit cards. Because when you open this credit card, in exchange for the $250, you will be lowering your credit score significantly. Because remember the recent activity factor, that's going to go down because you just opened a new credit card, and so your score will go down. So when you're opening the new credit cards, you need to really think about whether it's worth reducing your credit score for this credit card. My fourth tip for you is to try to keep your oldest credit card open in order to create longer credit history. So some credit cards have an annual fee, but if your oldest credit card doesn't have an annual fee, then there's no harm in keeping the credit card open, because this is going to create a longer credit history, which will keep improving your credit score. My next tip for you is to open a credit card as early as possible. So open your first credit card as early as you're financially ready and able to manage it responsibly. So don't open your first credit card when you're really young and don't have a job to be able to pay for the credit card, but open the credit card when you have a job that you can realistically pay for the credit card every single month. Because if you have a credit card and you're paying all the payments late, then your credit score will drop. But keeping a credit card and paying for it responsibly will increase your credit score, because starting your credit history earlier gives you more time to build a strong credit profile. My next tip for you is to check your credit report regularly for incorrect balances, accounts you don't recognize, and other signs of identity theft, because the credit bureau could make mistakes and someone could be stealing your identity. So it's important for you to check your credit report regularly. I would suggest every month, to make sure that if somebody is stealing your identity or if the credit bureau made a mistake, you catch the mistake very early and you make sure it doesn't affect your credit score. My next tip is to build your credit very slowly. If you're just starting out, just have one credit card and use it responsibly for several months. Get another credit card later if it makes sense for your goals. So don't just take out a bunch of credit cards because you want to build credit, because if you're taking out these credit cards, you have to be able to pay for them. And if you're not able to pay for them, that's going to really reduce your credit score. My next tip is to keep a mix of credit. As I said before, having multiple different types of credits, so for example loans and credit cards, can improve your credit score. However, don't take out a loan just to increase your credit score. Only get a loan if it's necessary for your goals. So get a student loan if you're going to college, an auto loan if you need it for a car, but don't take out a loan just to get your credit score high. And my last tip for you is to be patient. You're not going to start off with an incredible credit score, and it takes time to a good credit score. So keep having good habits consistently, and it will lead to a good credit score. So now that you know what a credit score is, how to get a good credit score, and what factors go into a credit score, we're going to move on to how credit cards work. So credit cards are essentially a short-term loan provided by the bank. So imagine you're buying a $50 pair of shoes. A debit card is money that will come directly out of your checking account. So this is essentially when you, for example, go to Nike and buy the pair of shoes, when you're using the debit card, you're essentially handing them $50 right then and there. However, with a credit card, it's essentially like you don't have the money with you at that time, and the credit card company is like your friend who's like, I'll pay the money for you. So the credit card company gives the store the $50 for your pair of shoes. However, they tell you you still owe them the $50. And so you have to pay $50 for the shoes to the credit card company at a later time. And for the credit card company, this is usually at the end of the billing cycle, which is every month. However, you are given a maximum spending limit for the credit card when you get it, which is based off your credit score, credit history, and income. If you pay the balance that the bank asks at the end of the month completely, you don't have to pay any interest. However, if you can't pay the full balance, you have to pay at least the minimum amount that the bank has set for the bill by the due date. If you don't, you have to pay late fees and your credit score will drop. If you pay the minimum amount, the rest of the money gets rolled over to the next month, but you have to pay an interest on that amount called annual percentage rate or APR. So that's a little bit complicated, so let me give you an example. If you had to pay the bank $100 the first month for your credit card and you couldn't afford to pay all $100 that month, you would pay the minimum amount, so say it's $30, and then the $70 that you didn't pay that month will get added to your next month's bill. So if the next month you spent $50 with your credit card, you would have to pay the $70 from the last month plus the $50 from this month, so a total of $120 plus whatever interest the bank says you have to pay because you're paying it later. So let's say that's $10. So you would be paying $130 that month. While using a credit card is beneficial for building credit and increasing your credit score, and it also has perks and protections, including cashback, travel miles, warranties, and fraud protection, it is important to be wary when spending on your credit card, because if you don't pay the balance every month at the correct time, the interest adds up really quickly and your credit score can drop dramatically, as well as it will put you under a mountain of debt. So it's really important to make sure that when you're spending with your credit card, you don't just keep spending money because you don't see it coming out of your bank account, because it will come out of your bank account at a later time. Alright, so now that you know how a credit card works, I'm going to go over a few terms that you're going to see that are associated with your credit card that I want you to get familiar with. So the first few terms are statement balance versus current balance. So a statement balance is the amount that you owed when your billing cycle closed, and this is the amount you should pay by the due date to avoid interest. So for example, for the billing cycle June 1st to June 30th, if you purchase $500 worth of items using the credit card, on June 30th, you owe the credit card company those $500, and the $500 would be the statement balance. However, the current balance is updated when you make a purchase, return an item, and make a payment. So for example, if your statement balance is $500 on June 30th, but that day you go to buy groceries using that same credit card and you spend $100, your new current balance is $600, but you only need to pay the statement balance by the due date to avoid interest. So you would only need to pay the $500 and you would leave that $100 for the next month. The next few terms that I have for you are due date versus closing date. The closing date is the last day of your billing cycle, and this is the date that your statement balance is calculated. So for example, June 30th is the closing date for the billing cycle of June 1st to June 30th. The due date is 21 to 25 days after the closing date. So this is the date by which you need to pay your statement balance to avoid interest and late fees. So for the June 30th closing date, the due date would be mid-July. When you're looking for a credit card, there are multiple options that are offered from different credit card companies and banks. And a couple of banks and credit card companies offer what is known as a reward card. So a reward is a bonus that credit card companies offer. So these are the things that you see on TV in ads. So for example, in ads, you may see that somebody can pay for all of the desserts in a restaurant because of the rewards from their credit card. Some other rewards that credit cards could offer are 1 to 5% cashback, travel points, airline miles, hotel points, purchase protection, extended warranties, rental car insurance, and fraud protection. However, it is important to remember that these rewards are a bonus for spending the money you already need to spend, and they aren't a reason to spend more money. So an important thing to remember is that earning 2% cash back isn't worth paying 24% interest. So don't spend more money than you need to spend just to get these rewards. So to close off, I'm going to be going over the top 10 biggest mistakes to avoid related to your credit card and your credit score. The first mistake is missing payments, which will significantly drop your credit score and affect the interest rates that people are willing to give you. Your second mistake is carrying a balance unnecessarily. You don't need to carry a balance in your credit card unnecessarily just to increase your credit score. It's actually better to just keep paying off the balances in order to avoid interest rates. The third mistake is maxing out your credit cards. Maxing out your credit cards will significantly drop your credit score because it shows banks that you can't spend without borrowing money, and it increases your credit utilization. Your fourth mistake is applying for too many cards at once. You should only apply for as many credit cards as you can pay for at a certain period of time. Your fifth mistake is closing your oldest card without a good reason. If you don't have to pay any money for keeping your oldest card open, there's no reason for you to close it because keeping that card open will not affect you and it will increase your credit score. Your next mistake is only making the minimum payment month after month. Making the minimum payment month after month for your credit card will actually increase the amount of debt you're under because the credit cards have really insane interest. They have 18%, 24%, 30% interest, which if you're only paying the minimum payment month after month, you're going to be stuck under a mountain of debt. Your next mistake would be ignoring your credit report. The credit report lets you know if someone is stealing your identity so that you can check it so that you can freeze your accounts, make sure that nobody takes out a loan in your name. Checking your credit report also makes sure that the banks haven't made any mistakes and put something that you actually didn't do wrong. Your next mistake is overspending because of rewards. Spending an additional $200 in order to get the rewards, such as airline miles, is not worth spending an additional 1 year under the debt of the credit card company because you can't afford to pay for the monthly payment. Your next mistake is co-signing a loan without understanding the risk. Co-signing a loan basically means that you are willing to take responsibility for that loan. So if you're co-signing a loan, you need to make sure that the other person can pay for the loan or you can pay for the loan, because if neither of you can pay for the loan, your credit score will drop. And the last mistake that people make is treating a credit card like free money. A credit card might seem like free money because it doesn't come out of your bank account automatically, but you have to pay the credit card company back every single month, or else you're going to be in a cycle of debt to the company, and you're going to end up paying a lot more than you need to be paying. So make sure whatever money you take out of the credit card is money that you for sure need. That's it for this week's episode. Thank you for listening, and I'll see you next Wednesday.